Welcome to our Active Investing Edge overview, where we combine quantitative models, fundamental analysis, and disciplined risk management to navigate market volatility. The cover graphic with the compass and rising chart reflects our goal: use data-driven tools and sound judgment to identify opportunities, manage downside, and capture sustained alpha across different market environments. This slide unpacks behavioral alpha strategies by explaining common investor biases like herding, overreaction, and loss aversion, then showing how we intentionally exploit those inefficiencies. By applying emotional discipline, contrarian positioning, and probabilistic thinking, we turn temporary mispricings into repeatable advantages that can generate sustained excess returns over time. Here we show a rigorous fundamental analysis framework that takes inputs like macro indicators, industry structure, business durability, competitive positioning, and management quality, then integrates them into a synthesized thesis. That synthesis is translated into explicit revenue, margin, and capital allocation trajectories, giving us quantifiable assumptions to guide valuation and investment sizing. This page contrasts intrinsic value with market-implied expectations, using DCF and replacement cost thinking as the foundation and a volatile market chart to show fluctuation. The core idea is to identify when market price diverges below intrinsic value, capitalize on temporary mispricing in high-quality franchises, and capture the outsized returns as that gap closes. When building portfolios, we balance conviction, risk, and return by concentrating on high-confidence ideas. We amplify research conviction while using optimal position sizing driven by expected return, downside scenarios, and correlation, acknowledging that concentration increases idiosyncratic risk but can deliver superior outcomes, typically targeting 10 to 20 well-vetted holdings. Our risk management framework emphasizes capital preservation through proactive position control, disciplined exit rules, and position resizing as conviction evolves. We layer defensive strategies such as hedging tail events and maintaining liquidity buffers, and we run continuous stress testing to ensure resilience across market cycles while preserving upside optionality. Entry and exit discipline is central. We look to enter positions during mispricing events like earnings disappointments, sector rotations, or macro scares, and we document every decision in journals. Exits are triggered when price reaches fair value, the investment thesis deteriorates, or superior opportunities emerge, ensuring systematic, documented, and repeatable decision-making. Transaction cost management focuses on patient accumulation and alpha preservation by using limit orders, dark pools, and volume-weighted strategies to minimize market impact. On the protection side, we actively manage bid-ask spreads, borrowing fees, and tax lots so execution and post-trade handling preserve the alpha generated by the investment process. Performance attribution and validation isolate skill by decomposing total returns into sector allocation, stock selection, currency effects, and timing to reveal what truly drove performance. We validate outcomes with metrics like time-weighted IRR and benchmark relative measures to ensure excess returns are real and appropriately compensated for the risks taken. Post-trade refinement is a continuous learning loop where actual outcomes are compared to projections, models and heuristics get updated, and systematic journaling converts mistakes into refined checklists. This structured feedback raises our hit rate, reduces behavioral errors, and turns experience into actionable rules for better future decision-making. We integrate machine learning and human judgment by using alternative data, satellite imagery, social sentiment, and other sources to accelerate idea generation and signal identification. Machine screens provide rapid signals while the human judgment bridge supplies contextual interpretation, prevents overfitting, and validates noisy signals for robust strategic decision-making. Finally, evolving sources of alpha arise from structural market shifts like passive flows, which create pockets of mispricing, and from opportunities in ESG arbitrage, private-to-public transitions, and geopolitical niches. By combining a disciplined investment process with adaptive technology, we aim to sustain outperformance as markets change.